Why are financial experts sounding alarms over potential market collapses and economic upheaval?
That's right. Experts like Jeff Snider, Stephan, and Ronnie Stöferle are here to decode the latest trends affecting your investments.
And in this video, we've condensed their hours of analysis into quick, actionable insights, saving you time and keeping you informed.
So hang tight. Jeff is first up to discuss the implications of a major U.S. credit rating downgrade and its economic impact.
And you won't want to miss Graham's breakdown of proposed tax changes and what they could mean for your wallet.
Finally, Ronnie will share his bold predictions for gold prices in the shifting economic landscape, definitely something to consider.
Today, we're reviewing an analysis by Jeff Snider from Eurodollar University, who dives deep into the economic metrics and what they mean for the markets.
Jeff points out that the recent downgrade in the U.S. government's credit rating by Moody's brings little surprise given previous downgrades by Fitch and S&P.
Jeff Snider elaborates on the recent downgrade by Moody's, explaining most market participants viewed it as overdue, considering past ratings changes.
He notes that the bond market's reaction was muted, emphasizing that Treasury yields respond more heavily to economic fundamentals than to credit ratings.
How does Jeff interpret the recent PPI data?
Jeff highlights that the PPI showed its largest monthly decline since 2020, indicating not just inflation fears, but actual price declines.
What does Jeff say about consumer confidence?
Jeff emphasizes that consumer confidence has hit a 45-year low, largely due to fears over rising unemployment and economic outlook.
What predictions does Jeff make regarding economic growth?
Jeff predicts persistent weakness in economic activity driven by declining consumer sentiment and a lack of robust growth indicators.
Based on Jeff's insights, how should investors position themselves?
Jeff advises investors to focus on safety and liquidity, given the current economic uncertainty and signs of potential downturns.
Today, we're breaking down the newly proposed tax plan by Stephan, which aims to provide substantial tax relief for many Americans.
Graham highlights several key aspects that can lead to significant savings, particularly for those earning under $150,000.
Graham discusses how under the new plan, workers in service industries can receive cash tips without incurring taxes, provided they meet certain criteria.
Additionally, Graham details how overtime pay could potentially be deducted from federal taxes, offering great benefits for eligible workers.
Graham explains that to qualify for tax-free cash tips, workers must be in sectors like hospitality and cannot earn over $150,000.
However, he notes that many people do not report cash tips, which may limit the actual benefit.
According to Graham, eligible workers could deduct overtime pay from their taxes, offering a financial incentive.
However, he cautions that only a small percentage of workers qualify for overtime pay.
Graham details that the new plan raises the cap for state and local tax deductions from $10,000 to $40,000 for those who itemize.
This change aims to benefit citizens in high-tax states, but significant state tax payments are necessary.
Graham predicts that several families could see financial relief under these changes, particularly those making under $150,000.
However, he warns that individuals should understand the nuances to maximize their benefits.
Graham concludes that it's essential for individuals to stay informed about the nuances of the new tax plan.
Understanding potential deductions and credits can lead to significant savings.
Today, we're diving into a significant warning from Redfin regarding the housing market's potential downturn.
According to Redfin, many housing analysts are now predicting a drop in home prices due to various pressures.
Redfin anticipates that home prices may dip by 1% by the end of 2025.
This prediction is supported by an increase in housing inventory while buyer demand is decreasing.
Redfin's data shows Texas has hit the highest inventory levels in years.
This surge in active listings is significantly contributing to the market's instability, creating downward price pressure.
There's a noticeable trend in buyer sentiment, with home purchases being canceled at unprecedented rates.
This shift indicates growing hesitation among buyers regarding future market stability.
Cities like Austin are witnessing considerable price decreases, with declines nearly 14% from their peaks.
San Antonio and Fort Worth are also showing year-over-year price decreases, which has serious implications for local markets.
If current trends persist, analysts suggest that home prices may continue to fall into next year.
The volatility of the housing market could lead to more challenges for prospective homebuyers.
As we conclude, it's essential for potential buyers to act carefully given these market fluctuations.
Staying informed on local market trends and conditions can significantly assist in making sound investment decisions.
Today, we're taking a closer look at the RV market's troubling decline, featuring insights from Nick at Reventure Consulting.
Nick notes that RV prices have declined by 25%, with sales having decreased significantly, reflecting broader economic challenges.
Nick discusses how the pandemic spurred a rise in RV sales, but now that demand is significantly reduced.
He highlights the dramatic drop in sales paralleling trends observed before the Great Financial Crisis. Nick emphasizes that the RV market's difficulties mirror the economic downturn of 2007 to 2008, indicating deeper economic issues.
What does this mean for average consumers?
It suggests discretionary spending is faltering, which impacts various markets reliant on such purchases. What financing challenges are potential RV buyers facing?
Nick explains that high interest rates around 8% are making RVs less affordable for many buyers. Nick remarks that despite the current downturn, demographic changes could support future RV demand.
This suggests a potential long-term recovery as financial conditions improve.
What does Nick foresee for the RV market's recovery?
Nick suggests a rebound in RV demand could occur as economic pressures alleviate, driven by shifting demographics. In conclusion, the RV market serves as a significant indicator of overall economic health.
Nick recommends that viewers monitor these evolving economic conditions, as they may present future buying opportunities.
Today, we're discussing insights from Jim Bianco on the dynamics behind rising bond yields.
Jim indicates that the current bond yield levels might not be the peak, which could influence investor strategies moving forward.
Jim Bianco mentions that the current bond yield levels might just be the start.
He emphasizes that even higher yields could occur if certain economic factors continue. Jim Bianco notes that investor sentiment can change rapidly in response to interest rate adjustments by the Federal Reserve.
What is the expected market volatility approaching these interest rate changes?
Indeed, Jim underlines that rapid interest rate movements can lead to heightened market volatility.
What are Jim Bianco's predictions regarding bond yields in the near future?
Jim forecasts that bond yields may rise significantly, impacting various investment sectors.
Jim Bianco stresses the importance of keeping informed amidst increasing yields.
He encourages a reassessment of investment strategies in response to changes in the bond market.
Today, we're exploring the future of money with insights from Ronnie Stöferle, managing partner at Incrementum AG, who co-authored the renowned In Gold We Trust report.
Ronnie's analysis outlines significant transitions in monetary dynamics, asserting that trust is becoming an increasingly scarce resource.
Ronnie underscores that the most crucial asset today is not merely gold, but trust itself, which is dissipating due to several factors.
He claims that political instability and escalating debt levels contribute to this erosion of trust, consequently boosting demand for gold as a safe haven. Ronnie notes that inflation appears stickier than anticipated, primarily due to psychological factors influencing market participants.
It's no longer solely about economic models. It's about sentiment regarding the future.
Ronnie points out that central bank gold purchases surged significantly, particularly among emerging markets, signaling a shift in monetary policy.
This trend clearly shows that these nations are prioritizing gold over conventional fiat currencies. Ronnie asserts that should economic pressures persist, gold prices may soar to between 4,800s and 8,900s by the decade's end.
These are ambitious projections, but they illustrate the increasing significance gold will have within the global monetary framework.
Ronnie believes the current global economic climate suggests we are on the cusp of a monetary restructuring.
This transition necessitates a reassessment of asset allocations, particularly towards gold.
Ronnie recommends that investors actively reassess their portfolios, increasing their allocations to gold and silver.
He further suggests viewing gold not just as a hedge against inflation, but as an essential asset for sustaining trust in monetary systems.
What a whirlwind of insights we've gathered today.
For sure. Guests like Ronnie Stöferle and Jim Bianco emphasized how much trust is dwindling in the market.
Absolutely. It's fascinating to hear Ronnie project gold could reach upwards of $8,000 by 2030.
And Jim's warning about bond yields as a critical issue really underscores the urgency for investors to stay informed.
Then you have Nick pointing out the RV market dropping drastically, just like what Redfin said about the housing market.
Right, different sectors yet similar underlying issues. That's truly a red flag for consumers.
And Graham's take on the tax plan was eye-opening too, wasn't it? He highlighted how it could help many, but might also strain the federal budget.
Exactly, and Jeff Snider's cautious tone reminds us that our economic outlook isn't all rosy.
So what should viewers take away from all this?
If you're watching this, remember to assess the information critically and stay informed.
For now, if you gain some knowledge from our expert discussions, please like, subscribe, and share this video.
Your support goes a long way in helping us bring you more insightful analyses.
And don't forget to catch our next video where we'll dive into the intricacies of global trade dynamics.
You won't want to miss that discussion.
Thanks for tuning in, and we'll see you next time.